Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 115. On today's episode, we're going to talk about the great week that the market finally had. What were some of the causes of that? We'll look at some of the companies that reported earnings. And we're going to do something today that is very difficult to do. We are going to try to discuss economics and how it impacts the market without putting everybody to sleep. Maybe we will put everybody to sleep, but we're going to discuss it. That is today's episode 115. So get your mind right and let's get to work. Well, welcome back to the show, everybody. As always, glad you joined me here. And so we talk about the stock market. We talk about the week we had. Finally had a decent, no, actually not a decent, a good week in the market. We worked off of that oversold territory. So we were, if you look at the S&P oscillator, we've been oversold for the past couple of weeks. So we finally had a good week, and the real reason for this is that the Federal Reserve came out on Wednesday. They didn't raise rates, and based on kind of the way they talk, reading the tea leaves, are they saying this? Are they not saying this? But it kind of looks like the Fed might be done, or they're very, very close to being done. They don't really want to say they're done, because just the threat of them raising interest rates changes the behaviors of the the people within the economy. And we act different, we spend money different, businesses plan differently, just thinking about the possibility of interest rates being higher, or at least being at this level for longer. And we'll talk about that in just a little bit. So we look, Apple had a good quarter. Initially, everybody wasn't thinking that they had a good quarter, but with Apple, they're not selling as many iPhones anymore, but you have to look, you got to go deeper. Everybody wants to be first level, and you got to go second level when you're doing your research, when you're looking at this. Think about how many, the average person, they just read the headline, they never even, go one layer deep. But when you look at Apple, the fastest growing segment for them is services. And I know we have discussed this before, but when you look at Apple and you look at the service growth and how much they're making on services, it's pretty incredible, because the more iPhones they have in circulation, the more that their users are going to sign up for services, things like, iTunes, the storage that you need to have, Apple News, like all of these things that we bolt on to our iPhone. It's a huge profit center for Apple. And the one piece you really have to think about with the service income for Apple is the margin on that is huge. So the margin is what it costs Apple versus what they sell it to us at, and that spread is the margin, which is what they get to keep, and they get to keep a lot of it. So their profit margin on the service income is massive. And so you look at that and you look how fast that is growing, and I realize they're not selling as many, maybe MacBooks as they thought they were going to sell, or maybe they're a little off on the iPhone. It's not a big number. I mean, it's, they're off just a little bit, but when you look at that service income, I'm telling you, that's the sneaky good part of their quarter. And even in the last 3 months, part of that quarter, they returned $25 billion to shareholders, and that was in the form of dividend and buybacks. So Apple buying back their own shares like they always do. I think this past quarter it was maybe 8 million shares that they bought back. And so if you're a shareholder in Apple and they're constantly buying their own shares back, again, that lifts the price of the stock. It removes shares from the open market. They're buying it on the open market just like you would or I would. So they're buying it from, and so, that basically puts a base there where they're constantly buying their own shares back, but they wouldn't be buying their own shares back if they didn't think it was undervalued. And so you look, they're set up pretty good for a holiday quarter. And then on Friday, we had the jobs number. The jobs number came in at a good pace, lower than expectations, which is kind of a weird counterintuitive thing to think about here, where we don't want as many people to get hired, which you'd normally say, man, people getting jobs is a good thing, but for the Fed conversation and for the economy, you want that number to be below expectations. And you look at this, and a lot of this stuff is counterintuitive. So when you look at just the economics of the market as a whole, the Federal Reserve, like their goal is to what they say is return us to price stability, which is get inflation down to 2%. And then also they want to help the economy reach full employment. So we're pretty, our employment numbers are good, and it's bringing inflation down to that 2% target, which is going to take a while. It's not something that's going to happen in a month, in 3 months. Like, it takes a while to get that to come down. So as they raise interest rates, it's supposed to slow the economy, right? So if interest rates are up, it makes the cost of everything more. So we discussed this, if you want to go buy a house, if you want to buy a car, if you want to borrow money, all of those things are now more expensive for you to do, which is, supposed to reduce economic activity. And because of that, if you reduce economic activity, in order for companies to get you to spend your money, they're going to have to start lowering prices, which would reduce inflation and kind of return things to normal, whatever normal is. I mean, after COVID and the 5 years that we've had here, before that, you look at 2019 to today, I'm not really sure what normal is going to look like. I mean, there's some, business is just different than it was. And so, there's going to be, it's going to take a couple years to kind of work through this. I saw some articles this week where they were talking about taking like old strip malls and turning those into like condos or areas for people to live. So when you look at all these like tentacles of raising interest rates, there's all these tentacles that go out into the economy that make things, it has repercussions that maybe we can't see yet. And so you kind of, when you think like an economist, when you think about how these things work, it's basically you pick one of these and you look and you just kind of carry it out. So when you look at housing prices that have gone way up, they have become very much more unaffordable for the average person. And because of that, because they've become unaffordable for the average person, you have to think about how many people they're going to have to rent now, right? So they're going to have to rent an apartment, rent a condo, whatever it is. And so because they're having to rent, there are builders out there that are going to be building more apartment complexes. But because interest rates are up, that means that the bank is going to charge them more to build those apartment homes, which means the builders are going to charge the renters more to be in those apartment homes, which means the people that are renting those apartments are no longer going to be able to maybe save enough money for a down payment on a home, which is going to prevent economic activity in the future, and it keeps people who are renting, from ever being able to move up. Also, think about all the people who bought starter homes a couple years ago when interest rates were 3.5%, and are they going to want to leave that house, go from a mortgage of 3.5% and move up to a mortgage of 6.5%, 7%, maybe 8%? Well, they're not going to want to do that, so they're going to stay in those starter homes. And so the people who are in those apartments trying to save money, I mean, it all comes together in this kind of negative way. And so then you might have banks later on who are trying to give loans to people where they start reducing the restrictions on, maybe you don't have to have a good credit score, and you don't have to put as much money down on a house. And so they get creative with the loans. And then all of a sudden, maybe we get into the 2008 predicament again. Hopefully not. But you have to think about these things when you're looking at companies you want to invest in, when you think about how the economy is going to work, when you think about the companies that you're looking to invest in, how is this going to impact them? There was a great article that I read this past week from Charlie Munger, Warren Buffett's right-hand man, where he talked about technological advances. And I mean, Charlie is going to be 100 at the end of the year if he makes it. Um, and so he's seen obviously a lot of technological changes over the years. And one of the things he talked about was when you look at technology changes as an investor, this is as an investor, the companies that you're looking to invest in. As an investor, when you look at technological changes, you have to ask yourself, is this going to be a technological change that passes through to the customer? Meaning that, like the cost savings or whatever this technology is going to do passes through to the customer where the business really doesn't benefit from it as far as being more profitable as a business. So, for example, that would mean, let's say there's a new machine out there that we can buy and we can produce T-shirts faster, as an example. Well, if every company that we're competing against also buys that machine, it costs us money just to be able to compete because we got to pay for that machine. But it really just allows us to be able to get the T-shirts to our customers faster, which is what everybody else is going to do. And so it doesn't really make our bottom line, the amount of money that we're making as a company. It doesn't really stick to us because it flows through to the customer. So hopefully I said that the right way. But when you look at a technological, some other piece of technology, is it something that actually makes the business, not only does it help the customer, but it actually makes the business more efficient, and it allows the business to be able to keep some of that money from that investment in that technology. So that could be something like a software program where you're able to maybe not hire as many people because the software is taking care of it. So maybe instead of having 10 employees, you have 5, but you're also able to service your customers better. And so then some of that actually stays with the company and makes the company not only more effective, but it also makes them more profitable. And so you can kind of see where I'm going with this, hopefully, where you look at AI and what are the things that are going to be able to, are they going to be able to replace some of the people? Are they not? And these are all kind of things we don't have answers to yet, but really it's more about how you're thinking about it, critical thinking skills, basically running through these kind of calculations in your brain and thinking about the companies that you invest in, and is this going to impact them or is it not going to impact them? And so by doing that, again, going back to the waste management example that I used a couple of weeks ago, where they were actually able to replace employees with some of their technology. And this was, positions that have a 50% turnover rate. And you look at labor in this country, and this past weekend, I taught an executive MBA class on economics. And one of the things I wanted to ask everybody in the room was about labor, and it was one of the big struggles that everybody in the room had, and they are all from different industries, defense, building, finance. I mean, just literally every single industry you can think of. And labor is one of the big deals. And training somebody, they take somebody, they brand new hire, maybe they don't have any experience, they train them up. What is the cost of that to that company? And then a lot of times, what is their turnover rate, which is how quickly somebody leaves them. And it's a huge cost to a lot of businesses. So a lot of them are looking for ways to be able to take some of the jobs that maybe aren't as complex and looking for ways that they can use technology, software, AI, whatever it may be, to kind of replace some of those positions. So not every business is going to be able to do that, obviously. But the ones that will be able to, when you think about it from an investor standpoint, I mean, that's going to have a big, that could have a big impact on their bottom line and the amount of money they're going to be able to keep. So it's going to be something that we're obviously going to be talking about for a long time because it's going to take a while to work through that. But when I'm researching companies, I mean, those are the kind of things that I'm thinking about when I'm researching companies and thinking about, is this going to be a good investment over the next 3, 5, 10 years? And how is their business going to change based on some of these things that we're considering? And so, not all technology is created equal, and obviously not all technology impacts companies in the same way. But when you look at the difference of kind of the technology companies that we've talked about, and you look at some of the companies that are very capital intensive, right? You look at an Exxon or a Chevron, a very capital intensive business, electric companies, very capital intensive. There's a lot of equipment needed, a lot of capital expenditures, Exxon, drilling rigs, pipelines, all those things, and you compare that to a Microsoft, Meta, those kind of companies, it's completely different. And so, when it comes to investing, you're looking for companies that are profitable, and especially in today's world, that don't have a lot of debt. Because going back to our earlier part of this episode, when you look at, just how much debt a company has, that is going to impact a company's ability to take on new projects. So there's something called the weighted average cost of capital, which is how much does it cost a company when you look at their borrowing costs. What is the rate they're paying for the money that they're borrowing? And so when they look at projects that they want to take on, they got to be able to make a return on that. So for example, if a company's weighted average cost of capital is 6%, well, they got to pick projects where they're going to bank more than 6%. Otherwise they lose money. So we're really getting granular today on this episode, but this conversation about how the economy works, why the Fed, rates impact everybody. I mean, it's an important conversation for you as an investor, because it's something you need to be thinking about, because it's going to impact a lot of companies. And over the next couple of years, I mean, it might be a case where the averages, the S&P 500, the Dow, the NASDAQ, they might not do as well because they have so many companies within those indexes that you really might have to select some individual stocks, like we have discussed, to really outperform the market and really to kind of be able to invest in the best companies in the world. And it's just gonna make a bigger difference as interest rates stay higher for longer. The other thing that I would tell you to consider is, when you're looking at companies that you want to invest in, look for companies that have like tiered options for their customers, because as times get tight, as people have less disposable income, so when you look at the rise of home prices and having higher interest rates, obviously people are going to have to pay more for those mortgages. So that reduces their amount of disposable income. Student loans started being paid back in October, which is also going to reduce the amount of disposable income. That's probably going to, impact somebody's ability to have a vacation or whatever. But, look for companies who have tiers where, maybe you can't buy the highest tier product they have. Maybe you're at the middle tier, but you can kind of trade up and trade down based on the products that they're offering you, where it's not just like, I can't afford that, but somebody who has different tiers. So an example of this would be somebody like Procter and Gamble. So they own Tide, right, which would be considered the high-end, maybe a high-end laundry detergent, but they also own Gain, which would be maybe a mid-tier laundry detergent. So you have the ability to move up and down their brands based on how your income is doing or how much money you have. So it's important for companies to be able to offer, substitute goods within their product line to be able to do this. Cars have done this for years, right? They have higher tier. You look at, Lexus is owned by, is it Toyota or is that Nissan? I can't. Nissan owns Infiniti. Jaguar is owned by Ford. So they have these, tiers where, as a consumer, you can move up and down based on how you're doing. So understanding that relationship as an analyst, as a potential investor into these companies, looking at these things, it does impact, your returns and a company's ability to be able to kind of shift based on what the market's doing. So now we're in a higher interest rate environment. What are companies going to be able to do? How much wiggle room do they have to be able to bring you on as a customer and allow you to still be able to do business with them, even though your dollar might not be going as far? So the companies that are better able to do that are going to do a better job of keeping customers, and when things get back to normal or better, they'll capture more of the market because of that, because of the habits of people. So all little things that, you kind of need to consider when or before making investment decisions and looking at different companies that I personally feel is important for you and kind of your success. So economics, not always the most fun conversation. I totally get that. Believe me, I totally get that economics is not always the funnest conversation. But it's important to understand these relationships because as an investor, I mean, you have to understand that. And also as a consumer, you have to understand that. So we can probably provide some, some diagrams or whatever to kind of hammer some of these points home to make them a little bit more crystal clear, which I think would probably be helpful. But we'll work on that, and we can kind of discuss some of this as we continue the conversation here. So, also today is my mind's all over the place. New York City Marathon Day. So I have some friends running the New York City Marathon today. Good luck to them. Exciting day. Some of them just getting started, even though the winners are already finished. But New York City Marathon, weather looks good. So, good luck to my friends running that race. Okay, so sum up economics today. Go read about the invisible hand from, I believe that's Adam Smith, and look at some of the economic theories that are out there, and just try to like kind of, play around with them in your mind a little bit, where you're just kind of thinking about the concepts here and see, how it impacts your thinking. It's more about how you think about things versus, just memorizing them. But that's definitely something that we should spend some time on. So, all right, I hope this was helpful for you. I'm going to stop rambling now. I got to cut this off. Hope this is helpful for you. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.